This is a refresh on an older video I did with up-to-date data, and the focus on this one is the options you have available to you when you come to take your income from your personal pension or your SIPP. Broadly speaking, this can be broken down into the following three areas: Flexi-Access Drawdown, Annuity, and Fixed Term Annuity. So let's get into this. My name's Ed Bailey and I'm a chartered financial planner. We're specifically looking at personal pensions, which is a broad term and includes SIPPs, private pensions and workplace pensions being the ones that you get auto-enrolled into. Gone out to the open market to get real-life quotes just to give some real examples of what levels of income are available presently. Obviously, these have been done at today's date and therefore will change over time. The starting point here is that we're assuming that you've decided to take the benefits from your pension, that you're 55 years or older, and obviously this will be moving to age 57 from 2028, and you've made the decision that you want to take the tax-free cash and an income. As I've shown in previous videos, you don't of course have to take this. You can take out some or all of the tax-free cash. You can of course choose not to take an income. I have a video that goes into more detail on the options of using either Flexi-Access Drawdown, UF+ or Small Plus right here. Whenever you come to take benefits from a pension, you do need to be mindful of, and this especially applies to older type personal pensions that can include guarantees or benefits in them that you would not want to lose. Guarantees can be such things as guaranteed annuity rates, guaranteed minimum pension, and protected tax-free cash. If you're unsure in any way, then you should seek financial advice. In this example, we'll keep it really simple. Is a £100,000 pension pot. The individual will be looking to take 25% tax-free cash, and then the remainder, the £75,000, will be used to provide a retirement income. Options then with the remaining £75,000 would be an annuity, a fixed term annuity, or drawdown, or as it's technically known as Flexi-Access Drawdown. If the income is taken from the remaining 75%, then it will be taxed according to the income tax rate that applies to you. For example, if you have your full personal allowance available, then the income that falls into this amount is not taxed. If it goes over your personal allowance, then it will be taxed at either 20, 40 or 45%. And those are the tax bands on the screen right now for 2021 to 2022. First of all, let's look at what this annuity looks like. And I've based these quotes on a person that's 60 years old. They are looking to take their income monthly in arrears and on a level basis. I should just mention that whether quoting for a male or female, it doesn't really matter, as the EU Gender Directive is concerned, as annuities have to be equal as far as either a male or female in the same position and age is concerned. If you are going to buy an annuity, please promise me one thing, and that is that you shop around for the best available income and do not simply accept the annuity offered by your existing provider. Around £1 billion a year is given up in potential retirement income by not shopping around for the best annuity on the market. Research by the SCA has shown that 8 out of 10 individuals who bought an annuity from their existing pension provider would have received a higher retirement income by shopping around. Or you can use the annuity comparison tool available on the Money Advice Service website. As always, the link is down below in the description. An annuity on a very basic level is simply you buying an income for the rest of your life using a lump sum of money. You would go to your chosen company, typically these are insurers such as Aviva, LV, Aegon, etc., and you would give them your lump sum of cash after the tax-free cash has been paid, and they would give you a return, a guaranteed income for life based on your chosen annuity basis, based on your age, health and lifestyle factors. Some of the factors you can choose would be whether the annuity is level or increases, whether you have a spouse's benefit built into it. Building in these factors will inevitably lower the starting level of annuity income. Something to consider is that yes, a single life annuity will provide you with a higher level of income. However, one of the most significant downsides to an annuity is that should you die and it's on a single life basis, with no guarantee or no spouse's benefit built into it, then effectively that pot of money is lost on death. The way that you win with an annuity is that you need to live as long as possible to get as much from that annuity as you possibly can. In this example, we've got a 60-year-old and they're taking their income monthly in arrears is on a level basis. We give the insurer the £75,000, bearing in mind the £25,000 tax-free cash has been paid into the individual's bank account. For £75,000, the highest amount currently available on the open market is £3,178 per year for the rest of their life, based on a single life level annuity on standard rates. Standard rates meaning there's no enhancements due to health or lifestyle factors such as smoking. An interesting thing here is that if we take our purchase price of £75,000 and divide this by our income of £3,000 per year, we would get to 23 years. So it would take 23 years to get back to their original purchase price. They would need to live beyond age 83 to get their money back. Now, annuities are not right for everyone, but this is also the same for drawdown. In some cases, investing is simply not right for everyone, and no matter who you are, none of us know what the future holds in regards to bonds or equities, and therefore for some individuals it simply does not make sense for them to take unnecessary risk where they don't have to, and I can completely understand this. We all know that at some point in the future you will have a stock market correction or crash, and when we look back at historical performance and see the recoveries, then we can find some reassurances. But equally, the strength of a guaranteed known level of income should not be underestimated. I think doing a combination of drawdown and annuities can be a powerful combination. Securing a level of income that broadly covers a large proportion of committed outgoing can be very reassuring, allowing risk to be taken with the remaining fund. The other potential critical downside to annuity on a level basis is our old friend inflation, and this will have a dramatic impact on the purchasing power of that annuity. Over the years, if we consider that 2.5% to 3% inflation over 30 years can reduce the purchasing power of money by around 50%. If we do build in some form of indexation, then this does impact on the starting level of the annuity. If we were to build in 2% per year increases to the annuity, so the income from the annuity would increase by 2% each year, this would decrease the starting level of the annuity to £2,349 in the first year. Obviously, this would then increase each year by 2%. The break-even point would come slightly later at age 84. And that's simply based on the return of the original purchase price. If we were then to add in any other benefits such as a spouse's benefit at 50% or 100%, then again that would also have an impact on the starting rate of that annuity. Very importantly, the annuity rates that I've provided are based on standard annuity rates. So this is based on the average life expectancy. If you've been diagnosed with an illness or have any kind of health problems that could potentially reduce your life expectancy, then you might be able to obtain a higher level of retirement income. So this is commonly known as an enhanced annuity. So possible health conditions that might come into account here are such things as diabetes, cancer, high blood pressure. This can mean that you would get a higher income. Other factors such as lifestyle factors, for example, smoking, will also increase the annuity rate available. The really important thing here is that you shop around for the best annuity rate, and secondly, you make sure that your lifestyle and health factors are taken into account when you are applying for your annuity. Definitely go out and compare this against the rest of the market. Next, I'll give you an example of a fixed term annuity. This differs in that you set a specific time period that you want income to be paid for, and at the end of that term, you then get a guaranteed value which you can then use either to buy another fixed term annuity, buy an annuity, or go into drawdown, or really a combination of any of those. We're still talking about £100,000. £25,000 has been paid out as tax-free cash to our 60-year-old. They then have £75,000 that will be used to purchase a fixed-term annuity. We're going to assume the same level of income as the annuity. With the fixed-term annuity, you can decide how much income you want to take from it. The impact will be on the guaranteed maturity value at the end of the 5-year term. So, if we choose the same starting level of income as the annuity of £3,178, then this will provide a guaranteed maturity value of £65,527 at the end of the 5 years. he would have had £3,178 of income payments per year for 5 years, and then he would have had a guaranteed maturity value as well. The key difference here between an annuity and a fixed term annuity is that the fixed term annuity gives the greater flexibility at the end of that term to then decide what to do next. It's not locking in an income for the rest of your life. With both the annuity and fixed term annuity, you're not taking any investment risk. It should also be mentioned with a fixed term annuity that you need to build in a death benefit, which can also have an impact on that guaranteed maturity value. Last but not least, and currently the most popular of these options is drawdown. It's pretty straightforward as far as actually how it works. You've obviously got the 25% tax-free cash that comes out. You then have your residual fund that you can then derive an income from, as in you effectively draw down from that remaining fund, and you can technically take anything from zero to the entire fund as an income payment to you. Do you need to bear in mind that obviously once the tax-free cash element is paid out, you then have the remaining 75%. Any money coming out of that 75% will be taxed at your rate of income tax. Obviously you take this out all in one go, then you're going to be paying the highest rate of tax, so you do need to think about that when you're working out how much income you're going to take from your drawdown plan. But essentially that is the same as with fixed term annuity and with the annuity. The key element to drawdown is that you're looking at how the investment is doing relative to the risk being taken with the money versus the level of income required or being taken, and this combined with how long you need the fund to last. It really is a balancing act between those elements to ensure both sustainability but also that you don't deprive yourself of income unnecessarily. If your plan is growing by 5% a year, then taking out 5% a year will broadly mean that you're staying level and your capital isn't being eroded. If you take 10% out a year and it's growing by 5%, then clearly you're going to be eroding your pension plan over the years, and ultimately that's going to last you around 19 to 20 years. And that may well be sooner than you would want the fund to run out. It's really important you understand when you do go and use your pension for your retirement income, the factors that you can control and understanding the various risks. It can vary enormously from individual to individual as to whether they even need to use their pension. They might not need in some cases, and I'll go into more detail in another video about drawdown, because there's some really specific things about drawdown which make it incredibly valuable asset as far as inheritance tax planning and death benefits are concerned. Thank you so much for watching. Please do let me know in the comments below should you have any questions at all. Thanks so much.